We have a guest today who's a veteran investor in the Indian markets and who today actually is convening a very important India investment conference and therefore can guide us as to what is the world view on India. My guest is Jayesh Gandhi, the Senior Portfolio Manager at Birla Sun Life AMC. But today he's wearing the hat of President of the Indian Association of Investment Professionals. He's joining from the sidelines of the India Investment Conference 2015, underway starting today in Mumbai. Jayesh, good morning and thank you very much for joining us. For starters, tell us a bit about the conference. I mean, what kind of an audience you get and what kind of speakers, just to get an idea of who are interested in India. Did you see more interest this time than you saw in the annual 2014 conference?
Oh, definitely. Our registrations have crossed the all-time high number of 450, and we'll probably have equal number watching the proceedings online as well. The response to the conference has been overwhelming, and we thank everybody for the same. The theme of the conference is from, you can get it from the name tag, which is how does the Modi government reboot India's growth engines and get India back to the growth path. And this is the critical question that is facing all the entire investment community and all investment professionals today. And this is critical that we get our domestic economic situation in order and get it right, because we don't have the tailwind of the global economy to help us this time around.
And your
so it is our own domestic economy and the policies.
Your star speakers include Arvind Panagaria and Jagdish Bhagwati as well.
No, Mr. Panagaria only.
Okay.
And we also have interesting speakers from the global arena. We have Vikram Mansaramani, who will talk to us on the forthcoming consumption boom in this country and across the world because of the drop in commodity prices. Then we'll have Russell Napier, who will talk to us about the deflation that the world is likely to experience and how investors should protect their wealth in this deflationary environment. And so it's going to be a mix of domestic economy, focus towards reigniting growth in India, and of course the way Indian investors should protect themselves from the global volatility, and what is the way forward in terms of investors in India, both equity as well as fixed income.
Okay. Jayesh, hi, good morning. Very excited to listen to some of the speakers at your conference, but how have you and the people you interact with assessed the Modi government's work so far?
Well, it's been pretty good, I would say, and while prior PM Modi has been credited for a number of successes in the last few months, my belief is that his principal success comes from the fact that he's been able to bring the growth agenda back on the table. He's been able to bring back confidence in the people of the country that they can themselves do it, and India can come back to a strong growth environment. No large big ticket announcement, but a series of important policy initiatives that we have seen in the last few months, which is driving towards a much stronger economic environment over the next few years. My personal belief is that we should probably hit 7-8% GDP growth in 2 to 3 years' time.
Okay, that's extremely encouraging to hear. But Jayesh, aside from that, let me invite your views even as a senior portfolio manager at one of the biggest funds in India. I was looking at some of your top holdings. You're heavily biased in favor of banks, especially private banks, and maybe NBFCs. You've got ING Vysya Bank, Yes Bank, Bajaj Finance, City Union Bank, Federal Bank, Repco Home Finance. You're rather a finance bird. You don't think PSUs deserve a place?
Well, it's not that PSUs don't deserve a play, but at this juncture and at this structure of the market, we thought best would be to play with private sector banks and NBFC, which have structural positives and the tailwind of the improving economy and the likely expected better credit growth in the next few months to really benefit.
For 2015, for 2015, will the bias be towards finance and within finance towards private?
Oh, absolutely. Our sense is that banking and finance should be the sector to really remain overweight on. We think BFSI, along with consumer discretionary and auto, should be the sector to look at. And as I look at the earnings estimates for and look at the growth for the next 12-18 months, I feel the biggest opportunity will come there. And of course, our bias would be on the private sector names, because we think that they will be the ones who will benefit the most in the initial phase, in the initial first 2 years of the economic expansion in India.
Okay, fair enough. You also have a fairly high exposure to autos and auto ancillaries. And the names that you've invested into, names like Bharat Forge, MRF, Eicher Motors, these are great businesses, Jayesh, but now they've become fairly expensive. Would you continue to be buyers into names like this, or do you think now the time has come to churn a bit?
Well, you know, as the saying goes, the time to sell a good business is never. So, you know, I rather stay invested in good companies, good names, good businesses with a long-term outlook. My sense is that, you know, the expansion phase and the increase in economic activity has just started. These companies which have been able to do well, even in slow growth environment in the last few years, will actually now have a much bigger opportunity and are very well positioned to capitalize on the growth that will come in the next few years. So it is better to be positioned in better names. That doesn't mean that we are not buying cyclically down stocks. They will also figure, but probably at this point of the cycle, we seem very confident. We are very confident to be invested in well-established and good business model companies.
Okay, just tell us your main themes for 2015. If you were to invest 100 rupees in, say, your frontline fund or in your mid-cap, small-cap fund, what will be the split be sectorally?
Well, like I said earlier, BFSI, private sector banks, auto, consumer discretionary are the areas where we would have overweights. I guess our underweights would still continue to remain metals, would still continue to remain some of the cyclical names. At some point of time during the year, they may get very cheap, and then we may start looking at them. The other area that we will very closely watch and look for green shoots and opportunities is capital goods and infrastructure plays. As the government starts implementing reforms on the ground, and as things on the ground start working, we will start looking at some of these names where the companies have good balance sheets, good business models, and start piggybacking on those as well. So broadly, it will be an India-focused portfolio with you know, some holdings or some overweight in pharma and of course IT. Again, good companies. So by and large, an India-focused portfolio is what I would say for the next 12 months.
Fair enough. One theme that has played out exceptionally well, Jayesh, is the paints sector. In fact, you know, most of these stocks are up, what, 50, 60, 70% in the last 6 to 7 months. You have exposure to names like Kansai, Nerolac. Do you think it's better to remain in some of the broader market paint companies, the Bergers, Kansai of the world? Or do you think that one can still be invested in names like Asian Paints?
No, but I guess it's across the sector companies will benefit. Consumer companies would probably have one of the best quarters in the next few quarters, from the simple fact that commodity or the raw material prices have collapsed in many cases, while they have the pricing power. So paint companies are good beneficiaries, and you have a whole lot of other consumer names which would be key beneficiaries. And my sense is across the board you could have your own picks depending on the comfort of valuation, depending on the comfort of the business model, and ride this wave. And my sense is the entire 2015 we could continue to see good earnings report from this sector.
Okay, what about the market itself? I mean, we have done 31% in 2014. What do you think 2015 can give us?
That's $1 million question, $billion question, I should say. Very difficult to predict one-year return. But you know, my view is that over the medium to short to medium term, say 1 to 3 year time horizon, market should remain constructive. Equity market should give you good returns. We will see volatility in the short run. We could, I mean, typical January seasonal volatility seems to be playing now. But if I look at 1 to 3 year time horizon, my sense is that equities would be the asset class to be in.
What is the reason for this almost $1.5 billion that has left India in the last, 4 or 5 weeks? I mean, we've got actually 1,000 crore sales over the last 2 or 3 days. The latest number is 500 crore. But how much of a worry is this?
Frankly, not much of a worry. While there will always be profit booking and global asset allocation, and what I'm hearing is this is largely ETF money which is going on. So it's basically global investors reallocating among regions or among asset classes. Not much of a worry, because I guess the most important thing is for Indian equity markets is that domestic investors are coming back. Remember, domestic investors are fairly underinvested in equities, and once they decide, there is a decision made on allocating money to financial assets, which is equity and fixed income funds. That money will really be able to substitute any outflows that, if at all, we see from the foreign investors. So I guess the great thing about India today is that both domestic as well as foreign investors are bullish, and not only bullish, they are ready to allocate more money into the Indian equity markets.
All right, you should learn a lot about that at the end of the conference, I assume, Jayesh. Thank you very much for joining us at what is a crucial and busy time for you. We'll touch base with your team after you are done with the conference to get your feedback. Thank you very much for joining us.
Thank you.